Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending April 21st, 2023. Looking at the market indexes for the week, the TSX and Russell 2000 were up, but the S&P 500, Dow Jones, and Nasdaq were down for the week. Oil and gold were down as well, oil down to $78 per barrel. Looking at Canada, on Tuesday we had a Canadian Consumer Price Index read for March. The core CPI year over year is good news, down to 4.3%. The month over month CPI was higher than expected and than the previous month, so that wasn't well received. Headline inflation is also 4.3%. So the easy part of bringing down inflation to 4.3% has been accomplished. Going down to 2% is going to be more difficult. In Canada, services inflation is going to be persistent and sticky. The tight labor market is causing this, and the higher interest rates are trying to slow the economy, to slow discretionary spending, such as restaurants. A looser labor market will lower the wage inflation we've been seeing. The transitory part of inflation, coming from supply chain issues, for example, has come off recently. The International Monetary Fund has come out with projections of GDP growth for the Western Hemisphere. Neither Canada at the very top nor the US are expected to be in a recession in 2023 and 2024. Some would argue that the Canadian GDP forecast for 2023 and 2024, even with the low numbers, seem a bit optimistic. The projections may be assuming immigration and housing to prop up economic activity. In general, this year and next year are expected to have major slowdowns from previous years, some countries going from double-digit growth in 2021 to low single-digit or even negative GDP growth. The IMF's new World Economic Outlook forecast growth to slow from 3.4% last year to 2.8% this year. Looking further ahead, growth is expected to remain around 3% over the next 5 years for the world as a whole. The Canadian consumer, however, is still spending, keeping the Canadian economy going. One of the reasons is that people feel well off. Since 2019, their net worth has gone up, and interestingly, and unlike in other years, the lowest income Canadians' net worth has come up the most, and the highest income Canadians, while better off, have seen their net worth increase only by 9% since Q4 2019. The lowest income Canadians are now keeping the economy going. The ongoing energy security crisis has demonstrated how shocks can shake systems out of a century-long inertia of the world's dependence on oil. Russia's efforts to gain political and economic advantage by pushing energy prices higher have spurred a major response by governments, not just in the EU, but in many countries around the world, to speed up the deployment of cleaner and more secure alternatives. The effects of all this are becoming clearer by the day. 6 months ago, the International Energy Agency showed that the repercussions of the war in Ukraine were reshaping the future of global energy, with a peak in fossil fuel demand clearly visible for the first time and set to happen before the end of the 2020s. This will be a historic shift. Fossil fuels have held their share of global energy supply steady at around 80% for decades. But the energy world is changing fast, and clean technologies are building momentum. The IEA's latest data indicates that the peak in fossil fuel demand is moving even closer. To be fair, I have been hearing that the peak fossil fuel demand is 10 years out for about 20 years. So we'll see. The International Energy Agency may be optimistic, as it usually is. One of the financial risks in Canada is the housing market, which is a large part of the Canadian economy, made more complicated due to the heavy indebtedness of Canadians. The mortgage stress tests and capital requirements needed by home purchasers as well as capital requirements for the lender, are kept in place for safety. Turning to the United States, US banks like JP Morgan, Wells Fargo, and Citigroup started reporting last week, and they beat expectations. The expectations were lowered in the last few months, but the banks would have beat expectations even prior to their being lowered. The big US banks have benefited from the regional banking problems as people pull their money from the smaller banks in significant deposit declines and deposit them in the big banks or in money market funds that provide 4 to 5% returns. Note that this week there were some misses, such as from Goldman Sachs. Bank of America posted its quarterly results early Tuesday, beating expectations on the top and bottom lines due to a boost from higher rates. Thursday, the US continuing and initial jobless claims came in higher than expected, suggesting the economy is slowing and US rate hikes may be done, or perhaps they'll have just one more. Wage inflation may also be slowing as people are less confident in keeping their jobs. When it comes to tightening credit availability, banks might just do the job for the Federal Reserve, according to Treasury Secretary Janet Yellen. The Fed has been raising its benchmark rate since last year, seeking to cool the economy and bring down decades high rates of inflation. But since the collapses of Silicon Valley Bank and Signature Bank last month and the ensuing turmoil in the system, there's pressure on the Fed to cool it with the rate hikes and avoid a hard landing for the economy. Quote, banks are likely to become somewhat more cautious in this environment, end quote. Yellen, herself a former Fed chair, said in an interview with CNN that aired over the weekend. Quote, we already saw some tightening of lending standards in the banking system prior to that episode, and there may be some more to come. End quote. Tesla's quarterly results this week came in just about in line with what Wall Street was expecting. Automotive revenue jumped 18% year over year, but earnings felt the crunch, falling more than 20%. The company blamed a number of factors for deteriorating profit margins, higher material and logistics costs, lower revenue from environmental credits, and, quote, underutilization of new factories, end quote. Tesla CEO Elon Musk also offered a gloomy outlook for the economy, saying he sees, quote, stormy weather, end quote, ahead. Quote, every time that the Fed raises interest rates, that's the equivalent to an increase in the price of a car, end quote, he said. Shares of Tesla fell about 7% in pre-market trading the day following. More US layoffs are coming. Facebook parent Meta, acting on CEO Mark Zuckerberg's, quote, year of efficiency, end quote, mandate, this week started its next phase of job cuts, focusing on employees in technical jobs such as in user experience, software engineering, and graphics programming. This wave is part of the round of layoffs announced in March, and more are coming next month. Meanwhile, Disney is expected to start its second of 3 planned rounds of layoffs next week. Several of those cuts will be at ESPN. Overall, Disney plans to cut 7,000 jobs by summer as part of a broader restructuring of the company. Now for some bits and pieces. The latest supply cuts announced by OPEC Plus countries on April 2nd risk aggravating an expected global oil supply deficit in the second half of the year and boosting oil prices at a time of heightened economic uncertainty. Even as industrial activity slows in the world's largest economies and production growth outside the alliance appears robust. That's the assessment of International Energy Agency's latest monthly oil market report, which notes that while oil demand in advanced economies has been lowered than expected in recent months, slowed by warmer weather and sluggish industrial activity, robust increases in China and elsewhere are providing a strong offset. Since oil markets were already set to tighten in the second half of the year, the latest cuts risk exacerbating the strains and potential supply deficit, pushing both crude and oil product prices higher. Consumers currently under siege from inflation will suffer even more from higher prices, especially in emerging and developing economies. China's GDP for the first quarter was a win for the bulls. The country's economy grew at 4.5% annual rate in the first 3 months of the year, according to China's National Bureau of Statistics, easily topping estimates of 4%. That's the best annual GDP growth rate for China in a year. Retail sales gave the economy a nice bump in March too, rising 10.6% thanks to a boost in e-commerce. Now that China has shed its onerous zero COVID policies, experts expect the growth to continue. While the Chinese government sees growth of around 5% this year, Goldman Sachs expects the country's GDP to jump by 6%. Quote, today's data are in line with our full year bullish view of China's growth, end quote, Hui Shan, Goldman Sachs chief China economist, said. Of course, China's numbers are to be taken with a grain of salt since they're occasionally fictitious. I should mention I have an investing thesis of emerging markets outperforming the US markets in the long run due to a growing population and easily improved business efficiencies. The US has done very well for a decade and may be overpriced. The trend has started in 2022, and today the price to earnings ratio, which is how much one is paying for a dollar of profits when they buy a share of stock, for US stocks is much higher than in other developed markets, and especially than emerging markets. Emerging markets and developed markets are below their long run averages, while the US is above theirs, showing the US is expensive relative to the others and to its own average PE ratio. This is something to consider. Finally, turning to next week, we have companies reporting. Monday, we have Coca-Cola and CNR. Tuesday, we have Microsoft, Alphabet, Visa, Pepsi, McDonald's, UPS, NextEra Energy, Verizon, Raytheon, GE, and the Canadian TFI International. Wednesday is Meta, CP Rail, Glencore, Waste Connections, Rogers, Tech Resources, and many, many others. Thursday is Amazon, MasterCard, Samsung, Comcast, Intel, Northrop Grumman, Activision, Agnico Eagle, Canadian Utilities, Bombardier, Whitecap Resources, Eldorado Gold, and Mullen Group. On Friday, we have Exxon, Chevron, TC Energy, Imperial Oil, and Cameco. Looking at economic events next week, on Wednesday is U.S. crude oil inventories, and we have Bank of Canada minutes. Thursday is U.S. GDP, U.S. core personal consumption expenditure, PCE prices, and indicator if there is inflation. We have U.S. initial jobless claims, and finally on Friday we have U.S. PCE, price index, Canadian GDP for the month. This concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.